We're going to close out day 2 of our forum here with the GASB update. We go to the next slide here. Again, I'm Anthony Cervini. Nice to be with you here. I'll switch gears here in a little bit and go into presenter mode. Also presenting along with me today is Nick Bava, also a principal here on our team here at Sikich. With that, we're going to go ahead and I'll pass things over to Nick to kick us off.
Good morning, everybody. Hi. So my name is Nick Bava. I am a principal here at Sikich as well. My focus is on the local government audit space, with specializing in the higher education space as well. So I'm excited to be with you here today and jump on into all things GASB and kind of what's coming down the pike here in the next handful of years and what will be relevant to your organization. So from an agenda perspective, I have a lot to cover here in a relatively short amount of time. I will highlight GASB statements 101 through 102 on compensated absences and certain risk disclosures. Anthony will then take over from there, talking about GASB 103, the financial reporting model improvements, and GASB 104, disclosure of certain capital assets, as well as just a look ahead into the what GASB has coming further down the road from their agenda perspective. So diving right into things. Let's talk about GASB 101 on compensated absences. So from a summary standpoint, while it's different in subject matter, and the overall impact that we experience from GASB 87 and 96 on leases and SPIDAs, this statement really continues down the path of looking at all the potential liabilities for governments and ensuring that they're properly recorded on your financial statements. So ultimately, GASB found that there was not only an inconsistency in how compensated absences were measured, but noted that there has been an evolution really in the types of compensated absences that are being offered. So these objectives are ultimately going to be achieved kind of by aligning the recognition and measurement guidance for all types of compensated absences under what they're looking at as a unified model, and by eliminating certain previously required disclosures. So that model itself, that unified recognition and measurement model, results in this liability that really more appropriately reflects when a government incurs an obligation for compensated absences. And then on top of that, additionally, the proposed model could be applied consistently to any type of compensated absence that would eliminate potential comparability issues, right, from one government to the next. So this model also certainly results into a more robust estimate, which we'll get into in terms of the amounts of compensated absences that a government will pay or settle, with the goal of enhancing the transparency, relevancy, and reliability of information that ultimately your organization reports within this liability. So with that all being said, when does this apply to my organization? So the effective date for GASB 101 is for fiscal years beginning after December 15th, 2023, and all reporting periods thereafter. So this would be December 31st, 2024 fiscal year ends, April 30th, 2025, and then June 30th, 2025. So clearly a relevant standard now, as this is going to be applicable for upcoming audits. So redefining compensated absences ultimately did come down to looking at that definition of what a compensated absence is. So what are we calling a compensated absence? How are we reporting a compensated absence? And really, what's the overall effect on our financial statements? So when you think about that, compensated absences can be defined as cash payments when the leave is used for time off. And if we have other cash payments, including payments that are for unused leave upon termination of employment, or if we have non-cash settlements such as conversion to post-employment benefits. Some examples with that we might see are vacation leave, sick leave, paid time off, parental leave, certain types of sabbatical leave. All these types of examples could fall under the definition of compensated absences. So as always, for accrued liability reporting, like compensated absences, we're required to separately categorize these items. So if we have that leave that's accumulated and hasn't been used by employees or otherwise paid or settled, we can see these types of forms that we've seen here. So whether they are compensated absence liabilities, defined pension liabilities, OPEB liabilities. We also have leave used by employees not yet paid by the employer. So these would include items such as salaries payable, payroll taxes payable, defined contribution, pension or OPEB plan contributions payable. So with that all being said, the question really then becomes, when do we have recognition? When do we have to recognize a compensated absence, right? So that's really the big question that we need to understand and answer as part of this standard. So with that, for leave that has not been used, we have 3 criteria that have to be met for this to qualify as a compensated absence, okay? So the first one here is it has to be attributable to services already rendered. So with that, like absences that are attributable to services rendered would be those, for which an employee already has performed the services required to earn the payment or the settlement. The second criteria is that it has to accumulate. And that means that employees can accumulate a bank of time and it can be carried forward from one reporting period to the other. So one of the important differentiators between old guidance and new guidance on compensated absences is that the criteria doesn't include vesting as a requirement. Last criteria here, number 3, is that it's more likely than not, and that term really is, anything above that 50% threshold, more likely than not to be used for time off or otherwise paid or settled. So in estimating the accumulated leave that is more likely than not to be paid or settled, your organization should consider significant factors such as your employment policies, your union contracts, things of those that nature that's related to compensated absences, in addition to, the historical information about the payment and ultimate usage of those compensated absences. So with that all being said, if we have leave used but not yet paid, we would have a liability for the amount of cash payment or non-cash settlement. And we would also, in that liability, we would include any applicable salary-related payments, such as FICA, in that calculation, which was, originally part of that liability calculation, in the old guidance as well. So from a measurement perspective, when we look at the measurement of this liability, there's really 2 components that we'll need to consider. First component is the pay rate. We're going to use the employee's pay rate as of the financial reporting date. And unless there's a compelling reason or a strong reason that an employee or group of employees are more likely than not to be paid at a different rate, you can use that alternative rate. But again, in most cases, you're looking at a balance sheet calculation, right? A snapshot in time. So it's important to be able to remember that as of that balance sheet date, that's the key. So I always like to remind, my clients that simple concept. If everyone were to leave today, what would you have to pay, and at what rate would you have to pay those employees? So with that, more often than not, you're likely to be using the pay rate in effect as of your fiscal year end date. Second measurement component, as I mentioned earlier, you can also have salary-related payments with this as well. Those can be directly or incrementally related. A defined contribution pension or OPEB recognized, we're going to recognize that as the related leave is earned. And it's not included in a pension or an OPEB liability. We'll get to that. And lastly, if we have a defined benefit pension or defined benefit OPEB, those would be excluded as any salary-related payments you may have as well. So I have a very basic example here to take you through. Just reading this real quick. An employee's annual pay is $100,000 as of June 30th, and it increased to $110,000 on July 1st. The liability is calculated based on $100,000. The effective rate increase will be recognized as an addition to the liability in the next fiscal year. So kind of looking at that, first off, congratulations to the employer for getting a 10% raise. Well done. But reinforcing the comments on my last slide, the compensated absence calculation is based on that salary and pay rate as of your balance sheet date. And in this example, June 30th. So any increase to the employee's salary, which is effective for July 1st, the next fiscal year, that would be recognized as an addition to the liability in that next fiscal year. So with any standard, we always have exceptions that we need to consider. So let's kind of look at those here. Excuse me, one by one. First here, if we have leave that is dependent on the occurrence of a sporadic event that affects a relatively small proportion of employees in a particular reporting period, we'll recognize that liability when that leave commences for that entire period. So some examples of these types of sporadic events would be parental leave, military leave, jury duty, things like that. Items that don't fall under this category are sick leave and sabbatical leave. We'll get into those here shortly. So for example, if we use parental leave in this instance, and under the new Statement 101 guidance, if we have an employee who begins a 90-day parental leave with 30 days before fiscal year end, then you have 60 days of liability that needs to get reported for that individual. As always, when you're thinking about these things, talk to your auditors about any materiality impacts, as it's probably unlikely that you'll have a significant portion of your employee base in this instance using parental leave. But again, having those conversations with your auditors, understanding the materiality impacts, as you're implementing and recording, is always recommended. Other exceptions to the general approach here, leave that is more likely than not to be settled through the conversion to a defined pension or defined OPEB plan. It's not recognized as a compensated absence liability. These amounts should and would be calculated and included within your actuarial valuations through pensions and OPEB, and those are in connection with GASB statements number 68 and 75. Additional items here: if you do have unlimited leave and date-specific holiday leave, you'll recognize that liability when the leave is taken. So for example, any employees that are entitled to a paid day off on January 1st, if they're in active service at your organization at the end of the day on December 31st, then no liability will need to be reported for that leave on your December 31st balance sheet. Some additional considerations here: if you are in a situation where you have the ability to accumulate unlimited leave, but maybe you're only eligible for a settlement of just a portion of that, say maybe a max number of days or a max number of dollars, the old guidance would tell us to accrue a liability up to that maximum settlement value. The new guidance here in Statement 101 tells us to accrue a liability for accumulated leave more likely than not to be used. Okay, we made our way to sabbatical leave. So certainly an important item to cover with this group here today, since this benefit can certainly be common in the higher education space. And we want to ensure, right, we're leaving no stone unturned as it relates to the requirements of Statement 101 and what benefits that might apply within this standard. So question is, do we have to accrue sabbatical leave as a compensated absence? And the answer, it really depends on the type of sabbatical leave being offered at your institution. If the employee is not required to perform any significant duties for your organization during the sabbatical leave, this is considered to be unrestricted and therefore meets the criteria for recognition of a compensated absence. Now, on the flip side of that, if an employee, say, is required to perform duties of a different nature for the organization during that sabbatical leave, such as research, this wouldn't be considered a compensated absence. So really, ensuring if sabbatical leave does apply and is utilized at your institution, understanding the difference there between the unrestricted and restricted sabbatical leave and how that would and would not apply. So for unrestricted sabbatical leave, the one that would apply under the standard, so that also accumulates when there is a minimum service period. For example, say if 7 years of service is required for employees to be eligible for unrestricted sabbatical leave, then that leave accumulates over 7 years. So with that being known, in evaluating whether unrestricted sabbatical leave is more likely than not to be paid, these governments should consider the likelihood that an employee will remain employed with the government long enough to become eligible to use the leave, and the likelihood that that unrestricted leave will indeed be used. So from a note disclosure standpoint, we do find ourselves in somewhat of a rare situation where GASB actually has taken away some of the reporting requirements. Historically, I'm sure folks know, we've had to report compensated absences, that liability in the long-term debt tables and those footnotes with a beginning balance, a gross increase, gross decrease, and ending balance. And if you didn't report it that way and you reported it net, you likely would end up with a comment from GFOA, for those that participate in the certificate program. So now, under the new standard and new guidance, we can report this net without the worry of a GFOA comment. So, while it's not the most groundbreaking removal of a footnote requirement, I'd still say it's a small victory and one of those things that, it's always important to celebrate the little wins, right? So from an implementation perspective, retroactive implementation is required if practicable. So we see those two words, if practicable, in quotes. So even though that's included in the language, GASB has taken, I'd say, a rather hard stance on this and really expects organizations to go through the retroactive restatement, even though it comes with a little bit of a larger time commitment. Remember to work with your auditors to discuss this and ensure the expectations are aligned going into that process. Similar to what we ran into with GASB 87 on leases and 96 on software, if you present comparative financial statements, you must restate both years. So, for any organizations with us today that say have a June 30th, 2025 fiscal year end up coming, and you do present comparatively, the standard would require that your financial statements reflect the restatement to the July 1st, 2023 opening net position, and that would be documented as a change in accounting principle. So these next few slides here, we'll go through just some really basic examples to kind of help get your wheels turning on types of benefits that may impact your organization. Some governments offer their employees general PTO, and that can be used for vacation time, sick time, other time off, really at the discretion of the employees. So this leave, in this example, because it carries over at the end of the fiscal year, and the leave is attributable to services already rendered, because there are no limits on carrying over unused leave, and any unused leave is paid upon termination of employment, you would accordingly all the accumulated PTO would be recognized within the compensated absence liability. Sick time here in another example, I would say that sick time is likely to probably be the most impactful in terms of changes as it relates to Statement 101, as generally, in terms of most policies we see, accrued sick leave is not paid out and does not vest. However, as I mentioned earlier, vesting isn't part of that recognition criteria, those three items we covered. So sick leave, governments offer leave to employees, right, that can be used when an employee is sick. Some governments allow employees to accumulate sick leave during their employment, but any unused amounts are forfeited upon termination of employment. So the leave accumulates because it carries over at the end of the year. Such leave is also attributable to services already rendered because employees can earn a certain number of hours or a certain number of days each month they're employed. So because of all of that, your government would estimate how much of the accumulated leave is more likely than not to be used as paid leave and recognize that portion within your compensated absence liability. So kind of simply put, with all that, governments do not need to record all of your sick time as compensated absences, just the portion determined to have a more than 50% likelihood of being used. A second sick leave example, this is very straightforward, but just important to reinforce, this sick leave here does not accumulate because it does not carry over at the end of the fiscal year. So in other words, right, it's unused leave and it's forfeited. So accordingly, such leave is not recognized within your liability in your financial statements. A couple other slides here on compensated absences, and then we'll get to a polling question here. Just some miscellaneous items that are important just to touch on. Leave not attributable to a specific employee. Say if you have an employee leave pool, you would measure the liability using an estimated pay rate that's really representative of that employee population. Changes to the measurement of the liability in future periods due to a change in pay rate, that should be recognized in the period of change. That's a sigh of relief that we're not having to go back and restate anytime pay rates change, right? Compensated absences paid to an individual account, say instead of directly to the employee, and those are to be used for specific purposes. Those should be considered and included in that liability for compensated absences. And then lastly, when determining that more likely than not to be used for time off, it certainly may be helpful to look at your classes or functions of employees instead of just the entire population of employees at your organization as a whole. Key takeaways here. I'd say, really work to understand your government's employment policies related to all types of compensated absences offered. Look at your employee handbook, right? Look at your personnel policies. Are there collective bargaining agreements? Really work to have a clear understanding of all relevant policies and benefits. It's certainly not a one-size-fits-all application. One institution's policies and contracts are going to differentiate from the next, right? So, it goes back to that first bullet point there and really reinforcing understanding the types of benefits and policies that are in place at your organization. And then lastly, just be proactive with your data extraction, looking at the usage of those hours, the sick hours, for example, and being able to lean on an historical analysis to support, that estimate of more likely than not to be paid and accrued into that liability. So, can't reinforce enough. Please reach out with questions. Happy to spend time talking through any questions you have, share best practices, implementations, experiences. Certainly anything that can help simplify, the implementation for your organization, please don't hesitate to reach out. Okay, so this brings us to GASB Statement 102 on certain risk disclosures. So looking at things from a high level in terms of what GASB is trying to accomplish with this particular standard, various types of stakeholders had expressed concerns about risks that governments face that may limit their ability to require resources or control spending. I'd say certainly concerns that were amplified as a result of the pandemic, a handful of years ago. When you look at, on the FASB side, they require non-governmental entities to disclose risks and uncertainties related to the nature of their operations, use of estimates, and its current vulnerability due to certain concentrations. So local governments, state and local governments face a variety of risks that could negatively affect the level of service they provide or their ability to meet obligations as they come due. And although governments are required to disclose information about their exposure to some of the risks, essential information about other risks that we'll get into, those aren't routinely disclosed because they really haven't been explicitly required. So with that, from an effective date perspective, when does this apply? It's for fiscal years beginning after June 15th, 2024, and all reporting periods thereafter. So we're looking at year ends that are June 30th, 2025, December 31st, 2025, and April 30th, 2026 year ends for the kind of the common year ends. So what are we going to accomplish from this standard? Really, the goal is improvements to financial reporting. What's nice out of this is these are simply just footnote disclosures, probably nothing more than a paragraph. We have an example for you at the end here of this section. But with that, the goal is to provide users of financial statements with essential information, like I said, that's not often provided under existing guidance. Disclosures will provide users with timely information regarding certain concentrations or constraints, and we'll get into those definitions here shortly. Ultimately, users are going to end up with having better information to understand and anticipate certain risks that might be facing a government and impacting their financial condition. So certain concentrations and constraints, GASB concluded that the identification of a concentration is a matter of professional judgment, and it can be based on both qualitative and quantitative factors. They determined that it wouldn't be overly burdensome or costly for a government to obtain knowledge of its concentrations or constraints for the purposes of assessing the disclosure criteria that comes with this standard. And they really based this conclusion on its belief that a government's existing concentrations or constraints are generally known by that government because those conditions tend to be fundamental aspects of its general financial risk profile. So with that, we'll go through the next slides here of some examples of what might be concentrations, what might be constraints, and see if any of these happen to be relevant to your organization. So a concentration, from a definition perspective, is a lack of diversity related to an aspect of a significant inflow of resource like revenue or an outflow of resource such as an expense. Some examples, not intended to be all inclusive here, but examples are employers. So a concentration might exist when a small number of employers comprise a significant portion of total employment in your jurisdiction. Say one employer moving to another jurisdiction or going out of business could result in a substantial increase in your government's tax base. Industries might be a concentration. Some governments may rely on a principal industry that dominates their tax base. Tax revenues could be lost or otherwise substantially affected if there's an industry disruption. Workforce covered by collective bargaining agreements. A government may be unable to adequately control spending if a sizable portion of your government's employees are covered by those CBAs that may lock in wages, benefits, staffing levels. Provider of financial resources. A sizable portion of government's tax base may come from a large or a small number of large retailers. Or if you're a business type activity, such as a utility, you may receive a sizable portion of revenues from a singular user. Last example here, suppliers of material, labor, and service. A government may be reliant on a particular supplier for unique or critical materials, and services may result in, and it may result in a spending-related concentration. On the constraint side, from a definition perspective, a constraint is a limitation that is imposed by an external party or by a formal action of your government's highest level of decision-making authority. So some examples, again, not intended to be all-inclusive here, limitations on raising revenue. There certainly may be constraints on a government's ability to obtain resources, and those could be imposed by creditors, grantors, contributors, enabling legislation, statutory or constitutional limitations such as tax caps, limiting the ability of levying property taxes, things like that. Limitations on spending. A government's ability to control spending may be adversely affected by limitations on what costs can be incurred and in what amounts. So, an example, debt covenants may stipulate the level of spending relative to a pledged revenue. Limitations on the incurrence of debt. There may be statutory or constitutional limitations in your area or state and on the total amount of debt a local government may incur. Mandated spending, mandates to expend resources, say on a particular program, certainly may diminish a government's spending flexibility by prohibiting that government from reducing spending on that particular program. So that is a little look into your concentrations and constraints. From a disclosure criteria perspective, a government should disclose in the notes to financial statements if all of the criteria are met. So all three need to apply. A concentration or constraint is known to your organization prior to the issuance of the financial statements. The concentration or constraint makes the reporting unit vulnerable to the risk of a substantial impact. In an event or events associated with the concentration could cause a substantial impact, have begun to occur, or are more likely than not to begin to occur within 12 months of the date of your financial statements. So for the purposes of determining the likelihood of the occurrence of an event, GASB concluded that criterion of more likely than not to produce a favorable balance between screening out events that may never materialize and providing information that's really essential to your financial statement users. Additionally, they believe that the focus should be on the general concept of the vulnerability to the risk of substantial impact, and they concluded that the term impact really broadly conveys that of a financially disruptive effect on the normal functioning of your government. From a notes to financial statements perspective, the disclosure should include the following: definition of the concentration or constraint, each event associated with the concentration or constraint that could cause a substantial impact if the event had occurred or had begun to occur prior to issuing your financial statements, and then any actions taken by your government prior to the issuance of the financial statements to mitigate that risk. And I will say, if mitigating actions taken by the government prior to issuing your audit have caused any of those three disclosure criteria to be met on the previous slide to not be met, then none of your note disclosures would be required. Risks refer to the conditions that give rise to the potential for loss or harm to a government. So certain conditions, may exist that make a government vulnerable to those risks and potentially expose the government to a heightened possibility of loss or harm. What's nice with that all being said is that GASB evaluated a variety of risks and determined the following items fell outside the scope of Statement 102. So these bullets here: general use of estimates, cyber risks, ESG risks, acts of God, war, sudden catastrophes, those would be outside the scope of what they're looking to accomplish here. From a reporting entity perspective, how should I consider this standard? You're required to report through the primary government's reporting unit, and that would include any blended component units if your organization has any. And also, if your organization reports a liability for revenue debt that may happen to become vulnerable to the risk of substantial impact. So an example of that would be, an alternative revenue bond where the revenue stream pledged to repay those bonds might be vulnerable to a substantial impact, and there's no backstop for repaying that debt. Okay, so with all of that being said and understanding kind of the nuts and bolts of Statement 102, we have a very basic example here for you. We'll go through the facts and circumstances and kind of the chain of understanding why we would need a note disclosure for this particular concentration. So College ABC with a June 30th, 25 fiscal year end was notified in August of 25 that the college's largest property taxpayer, Corporation 123, will cease operations at the end of the calendar year. Corporation 123 most recently paid 50% of the college's entire property tax collections. My little preschool toddler would love the names I've assigned to these entities here. He'd be very proud. Given the unique space and specialized configuration of Corporation 123, it's unlikely that another entity will acquire or occupy the property in the foreseeable future. And lastly, the college's financial statements are expected to be issued by October of 25. So now that we know the facts and circumstances, there is a concentration that exists. 50% of the college's property tax collections are associated with an individual corporation, and that's a significant revenue stream to the college. Vulnerability to the risk of substantial impact. Management of the college has determined that the concentration of resources provided by a single corporation makes the college vulnerable, right, to the risk of substantial impact. Then the occurrence of an event. And it occurred when Corporation 123 notified the college that its operations will cease. It's expected to occur by the end of calendar year 25, and management of the college has determined it could cause a substantial impact to the college. The notification event also occurred prior to the date of the financial statements being issued. From a mitigation standpoint, the college is planning to implement certain measures to attract new businesses. However, that did not occur prior to the issuance of the financial statements, and therefore description would not be included in the footnote example. So understanding all of that, here's what a disclosure looks like. I won't take you through it. I won't read it verbatim for you, but this is essentially kind of the footnote, end results in terms of what GASB 102 would accomplish. So remember, tying all this together, we're only looking at a note disclosure requirement here. Work to understand your organization's concentrations and constraints, and really go through that exercise of determining any that might make your organization vulnerable to the risk of substantial impact. So
we did have a couple of questions come in, Nick. I'll pose these real quick and comment on these and look for your insights as well. One question was, this is an Illinois community college who noted that their unused sick hours roll into the state university retirement system or a defined benefit pension plan upon retirement there. For GASB 101, they asked if they analyzed their sick time usage trends, and it turns out that on average, sick time used in a year is less than sick time earned in a year. Could they, in effect, assume that the unused sick time balance at fiscal year end is all going to roll to SERS? Therefore, we would have no new liability to record. The short answer on that is it's probably not. I think there'd be more analysis and data necessary to look into that and look as to what's going into those calculations there. But I don't think from a data set standpoint that necessarily that would play out as looking at that point in time balance sheet. There is still going to be a portion that is likely to be utilized by the sick time holder as actual sick time, where that there would be a liability there. Now the data may play out that it's not a material number there, and that's, again, with any new standard here from a materiality standpoint, that's a consideration that you would go through. Second question, Nick, was would state appropriations from a state public university be a concentration risk? Any thoughts on that one?
In terms of grant revenues, Anthony, is that how you're interpreting that?
I think more state appropriation. So it could be grant based, or it could be other allocated dollars for a state university there. My thought is potentially it could. Again, you'd have to look at it from a materiality standpoint there as to what that looks like there. So whether or not I think there may be a risk of concentration. Whether or not there is
Right.
any sort of requirement to disclose anything is noted there, right? So it may be a concentration. It may there may be a substantial impact consideration there, but again, it's that third criteria that's really going to knock a lot of these out of consideration there, is that is there an event or events associated with said concentration that that are happening, have begun to occur, or more likely than not to occur there. So I think in that example, right, if you look at a situation where for those of us in, in Illinois, if we were looking at a situation again where, the state wasn't able to pass a budget and there was concern over those appropriations, then that might be a conversation where that comes into play. But other than that, I think it's collectively looking at the other revenue streams, determining what those state appropriation amounts are as part of that, and then again looking at that third disclosure criteria. But any other thoughts on that one, Nick?
Yeah, I mean, hitting on the disclosure criteria is key, right? And is it going to lead to a financially disruptive event to your organization as a result of state appropriation issues? So, yeah, not needing to relitigate all of that, but that's again going through the chain of those three items, is key there in determining, the results of something like that.
Excellent. All right, well, we're very quickly, as we have just a short amount of time left, but really wanted to focus on Statement 101 and raise uniform guidance updates here. But we will cover for you GASB 103 on financial reporting model improvement. So next slide here, Nick. GASB 103 is effective for fiscal years beginning after June 15th, 2025. So that's June 30th, 2026 and December 31st, 2026. GASB's overall goal with Statement 103 was to look at certain components within the financial reporting model, build upon those, looking at revisiting the model, and try to generate a reporting model, or looking at the reporting model to ensure consistency in terms of what financial reporting looks like. Next slide. From a change standpoint, GASB had a lot of things on the table with GASB 103, and thankfully they very significantly scaled back what ended up making it into the final standard. So grateful for what kind of what ended up in the standard in terms of that. Certainly less impactful than it otherwise could have been. Management's discussion and analysis, which we'll talk about here, unusual and infrequent items, or what we used to call extraordinary or special items. Changes to your proprietary or business type activity financial statements, presentations for major component units, budgetary comparison information, and then finally information on the statistical section with financial trends. So on the next slide, we'll start off really kind of looking at some of the changes to management's discussion and analysis. To oversimplify what GASB did with the MD&A changes here is, MD&A had been in place, since the GASB 34, GASB 35 issuance in terms of kind of what was required to be presented under the existing model for that. And there were some boilerplate templates that were out there, and many folks utilized those. And what we got into is a situation where the standards, or the MD&As that we were seeing in reports, that GASB was seeing in reports, for those of you that participate in the GFOA certificate program there, ultimately we were getting a lot of data on what changed. We weren't getting the explanation on the why. So that's really what GASB focused on here, trying to simplify that. So as we look at the next slide, you'll see that GASB initially and currently has the following sections here. And for the sake of time, not going to go through each of these. Some of these may not apply to your organization based on the nature of the higher education institution here. But here's what GASB had in place. The next slide will tell us what GASB is moving that towards. So being able to effectively look at what is there, again, keeping that overview of the financial statements, having the financial summaries that have been part of that process as well, then looking at that detailed analysis, continuing to look at capital asset and long-term financing, and then finally closing out with any of those currently known facts, decisions, or conditions. On the next slide, we will see that the changes that existed here, again, are unusual or infrequent items. Definition for these did not change. It's just the terminology that's being used. So the transaction or the event has to be, again, unusual in nature and infrequent in occurrence. From a presentation standpoint, these unusual or infrequent items should be the last items presented on your position, on your change in position statement here, before you're changing that position or fund balance. Multiple items, these should be presented gross, not net. So you wouldn't want to net anything that falls under this unusual or infrequent item. You would want to separately identify those on the face of your financial statements. So an example that you might see for this is a disaster recovery grant that's intended to help a unit of government recover from an unusual or infrequent disaster. You have an inflow there, as well as a potential, in this case, an outflow, an impairment loss from the damage caused by that same natural disaster. Next slide. highlights for us some changes that will likely impact you all. And these are changes to our proprietary or business type activity fund financial statements here. Changes to the format, gives us some new definitions and some updates to the definitions for operating and non-operating revenues and expenses. And then finally gives us a new category on subsidies. So on the next slide, you'll see the information presented here. So continuing to present a detailed listing of the operating revenues of the organization of the entity, followed by operating expenses. That still brings us down to that same categorization of operating income or loss. The new category here that we have is non-capital subsidies. Again, a detailed presentation of those non-capital subsidies, a separate line item total there, and then a new subtotal of operating income or loss and those non-capital subsidies. Immediately below that, you'll find the non-operating revenues and expenses, detailed presentation where those are grouped together there, bringing you down to an income or loss before any unusual or infrequent items. Then your increase or decrease in fund net position, and then finally your fund net position at the beginning of the period and the ending fund net position at the end of the period. So not a huge change in terms of what that presentation looks like there, but a change nonetheless in terms of those subsidies being presented there and that new subtotal in the middle. As we look at the next slide, you'll see the definitions here as to what falls in those categories there. So from a non-operating subsidies, what types of amounts that could fall in there from a non-operating standpoint, operating revenues and expenses. Again, anything that is not a non-operating, doesn't fall in that non-operating category, is what you're going to have as revenues and expenses. But on the next slide, wanted to look at the definition of what a subsidy is, right? Because this is the new terminology that we have as part of that. So subsidies are resources that are received from another party or another fund for which the fund does not receive or provide goods and service, and directly or indirectly keeps the fund's current or future fees or charges lower than they would otherwise be. Could also be for resources provided to another party or fund. Again, the recipient in this case is not providing goods or services to the fund, and those are recoverable through the fund's current or future pricing policies there. And really all other transfers then, capital transfers are continued to be treated separately as part of this as well. So again, looking at that from through a different lens in terms of the, any capital related transfers that you might see. Next slide, please. Major component unit presentation here. So each major component unit should be presented separately in the financial statements, your front financial statements here. If that separate presentation, GASB tells us if it decreases the readability of the financial statements, you can show it as a single column with a combining column later in the report. Condensed statement presentation and the note disclosure is no longer allowed under Statement 103. The next slide here, we'll see this will not apply or be applicable to most entities here, but historically budgetary comparison information could be presented as a basic financial statement for governmental fund financial statements, no longer allowed under Statement 103. And then the next slide, we'll talk about our statistical information, the financial trends information. So this will apply to many of you when only business type operations or business type activities are presented. Presenting those revenues by major source, distinguishing again between your operating income or loss, those non-capital subsidies that we have in that new category, and then finally the other non-operating revenues and expenses. Next slide here, we'll briefly cover GASB 104, disclosure of certain capital assets here. We can be brief on this one because many of you are already likely doing this in some manner. This is just GASB kind of memorializing this into a statement here. Effective for fiscal years beginning after June 15th, 2025. So again, June 30, 26, December 31st, 26. Types of capital assets here that we're looking at, again, looking for the fostering of comparability between entities here. So what are the requirements? We need to separate the disclosure of information related to capital assets and related amortization by major class of asset for lease assets, intangible right to use assets as an operator under GASB 94, and then subscription assets under Statement 96, and then finally any other intangible assets that may not fall into one of those respective categories here. Key takeaway from this on Statement 104 is do not disclose any intangible right to use assets in the same major class as any owned asset of the same type. So these assets that fall under these categorizations do need to be treated differently. Next slide gives a brief example here. So you'll see on this example, this comes directly from Statement 104. So if you're looking to see more information on this, you can search that directly here. But here you'll see within the middle section, the capital assets being depreciated, a separate line for subscription assets, a separate line for lease assets for building and equipment, not included in the building and equipment line in that same section. Accumulated depreciation treated the same way. Again, separate amortization amounts for the lease assets and the subscription assets as well. Next slide, please. Always like to just cover here in our last couple minutes, we'll just highlight for you what's next on GASB's technical agenda here. So GASB met yesterday, actually is meeting today as well. One of the topics they discussed yesterday was ongoing concerns and severe financial stress. This is expected, the next milestone for GASB here is a preliminary views document. They did vote to have staff make some changes to that document. So we do still expect potentially a issuance of this preliminary views document in the first quarter of 2025. The 2025 implementation guidance standard, a final document, is expected in the second quarter of 2025. The comment period on the exposure draft ended back on January 24th. Infrastructure assets, preliminary views document was issued for that. There are now public hearings scheduled in February for that, with a final issuance. The expected timing for those public hearings being this month. Revenue and expense recognition coming up as well, an exposure draft, quarter 4 of 2025. And then subsequent events, their comments are due back on the existing draft on February 21st, 2025. So a good chunk of information out there, but certainly in terms of looking at what GASB's got on the list, still active, but not nearly as active as we've seen them in past years. So thank you for your attention, and thank you for attending day 2 of the forum. We hope to have you back for day 3 tomorrow. Tomorrow's sessions will cover neurodiversity and looking at neurodiversity on both the educator and employer side, as well as board governance. So with that, thank you again for your time today. We're ending pretty close right here on time, 12:01 Central. Appreciate you being here. Look forward to seeing you tomorrow, 9:30 a.m. Central. Have a great rest of your day, everyone. Thank you.